By the end of this video, you'll understand the real forces behind the yen's historic collapse against the euro, the two critical decision frameworks that separate winning strategies from losing ones, and exactly how to position yourself as this currency battle reshapes global markets. If you want to decode confusing market moves like this before they hit mainstream news, hit subscribe. We break down the economics that actually matter. Good evening, everyone. I'm Polaris AI. The yen just hit 188 per euro. That's not just a number. That's the weakest level since the euro was born in 1999, and it's forcing a choice most people don't even realize they're making. 188 yen per euro. That's where the Japanese yen landed this morning in Tokyo trading. The weakest level since the euro was introduced in 1999. But here's what most people miss. This isn't just about one currency falling. It's about two completely different economic strategies colliding in real time. On one side, you have Japan, holding interest rates near zero, defending a decades-old playbook of cheap money and export support. On the other side, Europe, aggressively hiking rates to fight inflation, tightening monetary policy at the fastest pace in a generation. And right now, you're standing at a crossroads. Do you align with Japan's low-rate, yen-weak strategy? Or do you bet on Europe's high-rate, euro-strong path? In this video, you'll learn three things. First, the surface-level differences everyone talks about. Second, the hidden trade-offs almost no one sees. And third, the two decision frameworks that determine which strategy actually works for you. By following this channel, you'll learn how to compare confusing options and make confident choices, even when the experts disagree. Let's start with what's obvious. Let's start with the obvious difference: interest rates. Japan's benchmark rate sits at basically zero, 0.1% to be exact. The Bank of Japan has held rates this low for over a decade, refusing to budge even as inflation finally appeared. Meanwhile, the European Central Bank has jacked rates up to 4%, one of the steepest hiking cycles in its history. That's a 4 percentage point gap. And in currency markets, that gap is everything. Higher rates in Europe make euro-denominated assets more attractive to global investors. Money flows toward higher yields. The euro strengthens. Lower rates in Japan make yen-denominated assets less attractive. Money flows out. The yen weakens. It's Economics 101. This is the surface-level story you'll hear on every financial news channel. Japan keeps rates low to support its export-heavy economy. Europe raises rates to crush inflation. The yen falls. The euro rises. Simple, right? But here's the thing. This surface-level comparison only tells you what's happening. It doesn't tell you why it matters, who it hurts, or what trade-offs each side is accepting. That's where it gets interesting. So what does each side gain? Let's be fair. Japan's low-rate, weak yen strategy has real advantages. A cheaper yen makes Japanese exports more competitive globally. Toyota, Sony, Panasonic, every product they sell abroad becomes cheaper in dollar or euro terms. That boosts revenue. It protects jobs. It keeps factories humming. For an export-dependent economy like Japan, a weak yen is a deliberate policy tool, not an accident. Japan's government has openly supported yen weakness for years because it directly supports economic growth. Now flip to Europe. Europe's high-rate, strong euro strategy also has clear wins. Higher rates crush inflation. Eurozone inflation peaked above 10% in 2022. By late 2023, it had dropped closer to 2.5%. That's painful but effective. And a stronger euro makes imports cheaper: energy, food, raw materials. For a region that imports most of its energy, that's a massive cost saver. European consumers benefit directly. Gas prices stabilize. Grocery prices ease. Purchasing power improves. On the surface, both strategies look smart. Japan protects exporters. Europe protects consumers. But every choice has a cost. And that's what we need to look at next. Here's what most analysts overlook. Japan's weak yen advantage comes with a hidden cost: imported inflation. Japan imports most of its energy, food, and raw materials. A weaker yen makes every barrel of oil, every ton of wheat, every chip component more expensive. Japanese consumers are paying more for groceries, gasoline, utilities. Real purchasing power is falling even as exporters celebrate. Wage growth in Japan has been stagnant for decades. Inflation is now running ahead of wages. That's a quiet crisis. Meanwhile, Europe's strong euro, High-rate strategy has its own hidden cost, debt stress. Higher interest rates make government borrowing more expensive. Countries like Italy, Spain, Greece, nations with high debt-to-GDP ratios, are now paying significantly more to service their debt. That squeezes public budgets. It limits fiscal flexibility. It raises the risk of another sovereign debt crisis. The European Central Bank is walking a tightrope. Raise rates too much, and you break the weakest economies. Raise rates too little, and inflation comes roaring back. This is the trade-off no one wants to talk about. Japan sacrifices consumer purchasing power to protect exporters. Europe sacrifices fiscal stability to protect price stability. Both are making bets. Both are accepting risks. The question is, which risk matters more to you? So how do you decide which strategy works for you? Let's introduce the first decision axis, your export exposure. If you're heavily exposed to exports, meaning your income, your portfolio, or your business depends on selling goods or services abroad, Japan's weak yen strategy is your friend. A weaker yen boosts export competitiveness. It increases revenue in yen terms when foreign earnings are converted back. Japanese exporters, multinational manufacturers, and investors holding Japanese export-heavy stocks all benefit directly. If you're a Toyota shareholder, a weak yen is good news. If you're a European importer buying Japanese goods, a weak yen is also good news. You're paying less. But flip the axis. If you're a domestic consumer or a saver holding yen-denominated cash, a weak yen is terrible. Your purchasing power is eroding. Your savings are worth less in global terms. Imported goods, food, energy, electronics, are getting more expensive. If you're a retiree living in Japan on fixed income, this is a disaster. On the other hand, if you're holding euro-denominated assets or earning income in euros, Europe's strong euro strategy protects your purchasing power. Imports are cheap. Travel abroad is affordable. Your savings hold value. The first axis is simple. Are you an exporter or a consumer? Are you earning in the strong currency or the weak one? Your answer determines which side of this trade you want to be on. Now here's the second axis, and this is where it gets really interesting. Your time horizon. Are you optimizing for short-term stability or long-term growth? Europe's high-rate, strong euro strategy is a short-term stabilization play. It fights inflation now. It protects purchasing power today. It defends the currency in the present. But it comes with long-term risks. High rates slow growth. They increase debt burdens. They reduce fiscal flexibility for future crises. If Europe stays high rate too long, it risks choking off the very growth it needs to sustain its currency strength. Analysts suggest that Europe's strategy works if inflation is truly transitory. If you can hike, crush inflation, then cut rates and restart growth. But if inflation persists, or if debt stress breaks a major economy, the strategy unravels. Japan's low-rate, weak yen strategy is the opposite. It accepts short-term pain, imported inflation, consumer squeeze, in exchange for long-term structural support. By keeping the yen weak and rates low, Japan is betting it can sustain export-driven growth indefinitely, avoid recession, and eventually reflate the economy from the outside in. It's a longer, slower play. The question you have to ask yourself is this: do you need protection right now, or are you willing to endure short-term pain for long-term positioning? If you're managing a portfolio with a one-year horizon, Europe's strategy looks smart. If you're thinking 5 to 10 years, Japan's strategy might make more sense. Time horizon changes everything. So who should choose which path? If you're a Japanese exporter, a multinational manufacturer, or an investor holding export-heavy Japanese equities, Japan's weak yen strategy is built for you. You benefit directly from currency depreciation. Your revenues rise. Your competitiveness improves. You don't care about imported inflation because your income is growing faster. If you're a European consumer, a saver holding euro deposits, or someone planning to buy imported goods or travel internationally, Europe's strong euro strategy protects you. Your purchasing power is stable. Inflation is falling. Imports are cheap. You're insulated from global commodity price shocks. But here's the crossover. If you're a Japanese consumer or retiree on fixed income, you're on the wrong side of Japan's strategy. You're paying the cost of export support without reaping the benefit. If you're a European debtor nation, a small business borrowing at high rates, or a government facing debt rollover, you're on the wrong side of Europe's strategy. You're paying the cost of inflation control without getting relief. The fit isn't about nationality. It's about your economic position. Are you earning in the strong currency or the weak one? Are you exporting or importing? Are you leveraged or unleveraged? Are you optimizing for now or later? Your answers determine your strategy. The yen hit 188 per euro. That's a record low. But it's not a random number. It's the result of two deliberate strategies colliding. Japan is choosing export support over consumer protection. Europe is choosing inflation control over fiscal flexibility. Neither is right or wrong. Both are trade-offs. Your job isn't to pick the winning country. Your job is to pick the strategy that aligns with your position. If you're export-exposed and long-term focused, align with Japan. If you're consumer-focused and short-term optimized, align with Europe. The clarity comes from knowing your axis, exposure, and time horizon. Most people never ask those questions. They just react to headlines. You now have the framework to decide. And here's the thing. This comparison framework works for everything. Stocks versus bonds. Growth versus value. Risk on versus risk off. Every financial decision is a comparison with hidden trade-offs. If you want to keep learning how to compare options, see the hidden costs, and choose with confidence, subscribe. We do this every week. Next up, we'll break down the Bank of Japan's next move and what it means for the yen in 2025. Thanks for watching.